Thanks for joining us for this live webinar on how to plan for a successful pharmacy sale. We'll give a couple of minutes for any latecomers to log in, and in the meantime, let me just explain. Today's webinar is going to focus around a hypothetical case study, and we've uploaded a background information sheet that you can read through by clicking the link in the download section on the right-hand side of your screens. It's a good idea for you all to have a glance through this now so that you're familiarised before we get started. And the next few minutes is also a good opportunity for you to get yourself a drink, make yourself comfortable. We do expect the webinar to last about an hour and a half. Okay, so hopefully everyone's kind of back and had a read through that, so we'll get underway. Thanks again to everyone for registering and listening in this evening. I'm Scott Hayton from Hutchings Consultants, and I'm very pleased to be joined once again by Paul Savuto from DGS Financial Planning, Tim Jenkins from Charles Russell Speechleys, and Artif Butt from Hutchings Accountants. Our aim tonight is to demonstrate some of the pitfalls that pharmacy sellers can unwittingly fall into during a sale, and the importance of having good advisors behind you who can work together as a team, helping you to improve the value of your business, reduce your tax bill, and overall help provide you with a more comfortable retirement. So we're using the hypothetical case study of Lucky Star Pharmacy and its owners Raj and Simran Patel, and this is to help demonstrate the various stages of the planning and sale process. In our case study scenario, the Patels have owned and operated Lucky Star Pharmacy since 1993, and Paul at DGS has been helping them in respect to their finances since they acquired the business. In January 2018, they approached myself and Tim to ask about valuation and the process of selling, even though in their own minds they'd planned to hold on to the business for a few more years yet. And this is where the story kicks off for us as Paul, Tim, myself and Artif advise the Patels on some key points around preparing for sale and retirement and how they can make the most of this process. Paul's going to start this off for us just with some detail of how he assisted the Patels in their early years of ownership. But before I hand over, I'm sure there's going to be some questions as we work our way through. In the panel on the right-hand side of your screen, along with the downloads for tonight, you'll find a dialog box for submitting your questions. These can be asked at any point during the webinar, and depending on how many come through, we'll respond to those at the end as time permits. Of course, any questions we don't get around to this evening, don't worry, we will come back to you during the course of tomorrow with our thoughts. So with that bit of admin out of the way, here's Paul to get us started.
Good evening, everybody. I'm Paul Savuto. I'm a chartered financial planner, and I've been working alongside Hutchings Consultants for the last 3 years, assisting their clients preparing for sale and also helping them organise their finances once the sale has gone through. So those of you who don't have a financial advisor, if you were looking for one, you'd want to find somebody like ourselves who are independent and we're chartered, and we've also got the gold standard, as you can see. Just a little bit about DGS. So we've been established for over 20 years. We have 4 offices. We have 8 chartered financial planners, 29 independent financial advisors, and lots of admin staff. So we're a fair-sized firm dealing with day-to-day inquiries from many sources of clients. What do? We help you visualize your future. So the important thing is to prepare a plan. Very often we see clients who come to us at all stages of their life and have no idea what they need to do with their finances or what happens should the worst case scenario come across. So we're there to help you visualize your future, create a plan. We also provide you with peace of mind. So we're there as a sounding board to save you time, which you can never get back. We often help prevent expensive mistakes, and I call it financial coaching, to help educate our clients with regards to what investments are, what pensions are, to help them not to lose their money. We're often the number on the fridge, the second person you would call in the event of a disaster. We often get phone calls from clients when things go wrong, and we're happy to help. And most importantly, I think we simplify financial affairs, keeping them organised and structured so that everybody can understand what they've got and what the goal and aim of it is. The most important thing as well is we help clients identify, achieve and maintain their desired lifestyle without running out of money or dying with too much. As most of you know, we're only here for one life, so it's very important to make sure we can do what we want to do from now all the way through until we die. Obviously, the key is not to run out of money in having all the holidays and spending and giving the money, but also we don't want to die with too much regretting not doing things in the past. How do we do all that? Well, it's very simple. We provide you with advice regarding your financial matters, and very importantly, with all our clients, we have regular planning meetings to ensure you're on track to achieve your goals. Without a plan, without these meetings, things get left, tax structures get missed, deadlines get missed, and finances, as we see quite often, are left in potentially the wrong vehicles for investment. At DGS, we can help you in many areas, such as wealth creation, preservation, investing your money in ISAs, for example, pensions. There's a lot going on with pensions, so helping you accumulate and then extracting the money as you get into retirement. If you're lucky enough to have a large estate, we can help you with inheritance tax. We have colleagues that can help you with mortgages, buy-to-let, equity release, and importantly, family protection. And of course, should anything happen, we can help you write a will and have powers of attorney. So when I met Raj and Simran many years ago, I said to them, if you do nothing, then all you will have to rely on in retirement is the state pension. Currently, for working 35 years and paying national insurance, if that was all you did and all you saved for or relied upon, you would get £168.60 per week. So for most people, that's obviously not enough to live on. So we have to put in a plan. How do we achieve what we want to achieve from now until retirement? So 25 years ago, what did we discuss? So Raj and Simran were in the early stages of building a career, building their pharmacy, and obviously looking to have children, buy a house, etc. So the most important thing that we looked upon was we built a financial plan. But 25 years ago, it was quite straightforward. It looked something like this. So basically all they said to me was, we know we want to retire at 60 and we'll probably die at some stage in the future. And that's what they said. So, okay, quite easy, but what did we do? So to start with, we thought about family protection. So obviously when they first started out, there was just the two of them, they bought a house. So it was about protecting each other should the worst case scenario happen. So the what if scenario, what happens if they die? What happens if they're ill? What happens if they can't work? And we provided protection in the event of those things or disasters happening. So life cover if they die, critical illness should they get cancer, etc., etc. Protection is the core of financial planning to make sure that everything is protected and you can carry on with life should the worst case scenario happen. We also looked at retirement planning, even though it was a long way off. And back in the day, they could only afford £50 a month into their pension. Back in the day as well, there was Tessers. So they started paying into Tessers with what they could afford. So £50 a month, year on year, we increased that. So it became £100, £200, £300. Then we looked at the company paying in the pension contributions, making use of all the allowances that we had. So looking at personal taxation, we discussed inflation, what effect that has on their money. And obviously I talked about on this screen here, I've got mortality at age 100. Stats say these days that there's a 1 in 10 chance that all of us are going to live to 100, which is quite worrying. So more important to make sure we save now for the future. As I mentioned, we helped them with their mortgages for their first house, and as they acquired more wealth, they remortgaged and got a new house. They had children, so importantly, we made sure they wrote wills just to make sure they had guardianship clauses in there, so somebody could look after the children. That was a very basic plan that we had in place, was to start saving small bits into pensions, ISAs, make sure they were protected should anything happen, and then over the years, every year we went back, assessed their situation and agreed what the plan was, what they were going to do now, what spare money they could put away for the future, what money they needed for today. And that's what we did. So the plan now is quite straightforward. I'll come back to you later on where we'll see, once they sell the pharmacy, what the plan then looked like and how that was structured. I'm now going to hand over to Artish.
Thanks, Paul, and hi everyone. My name is Artif Butt and I'm the Senior Accountant at Hutchings Accountants. We've been specialising in pharmacy sales for over 30 years and I'm here to talk a little bit about what we've learned along the way. Now we're going to start off with a question. When do you think is the best time to start preparing for your pharmacy sale? Well, believe it or not, the right answer is today. The truth is, it's never too early to start getting ready, even if you don't plan to sell for many years. Being properly prepared can make a huge difference in not only the price you eventually get, but also how much you're left with to maintain your lifestyle over the course of your retirement. Now, as we've heard from Scott, Raj and Simran Patel approached Hutchings in late 2017 to obtain a free valuation of the business so they'd have a good understanding of what it might be worth. Following this initial conversation, I was able to introduce myself and offered to provide them with a free review of their accounts and tax position. Once you've decided you want to sell your pharmacy, we review the position to recommend the most tax efficient way to proceed. Getting the structure of your sale right can have a huge tax implications that could make a difference of hundreds of thousands of pounds to your eventual tax bill. So it's important to look at this as early as possible, as it sometimes involves making changes to the company or seeking clearances from HMRC. The Patel's pharmacy was trading through a limited company, Lucky Star Limited, and the first thing we looked at was whether Patel should sell the business through a share sale or an asset sale. Here's Tim Jenkins from Charles Russell Speechleys to talk about both options. Over to you, Tim.
Thanks, Artif. Good evening, everyone. My name is Tim Jenkins. I'm a partner with Charles Russell Speechleys. We are specialist pharmacy lawyers. One of the areas that we cover in particular is planning for and dealing with the sale and purchase of pharmacy businesses. We've been working with Scott and his team at Hutchings & Co for over 15 years now. So, as Artif has mentioned, the business is operated through a limited company, which means that Mr. and Mrs. Patel have a choice as to how they go about their intended sale of the business. They can either sell the shares in the company to their purchaser, or the company can sell the assets of the business to the purchaser. So I'll take a couple of minutes just to compare and contrast each of those. Looking firstly at the option of the company selling its assets to the purchaser, this involves a change to the operator of the business. Obviously, there is a transfer of the assets of the business and the contracts that support and underlie it, which would include the NHS pharmacy contract, of course, for an NHS pharmacy. In this situation, there are a few things to bear in mind, the first of which is that for transfers of ownership of NHS pharmacy contracts, the consent of NHS England, or if it's a Welsh pharmacy, the local health board, is required, and that has to be obtained before the sale can be completed, which is important to consider because there is a timeline around that process. It's a little bit quicker in Wales, but at present, average timelines in England to obtain a change of ownership consent can be anything up to 3 months. So planning that into the process and timeline for the intended retirement date is important. Also, where there is a change to the operator of the business, there's obviously a transfer
of the employer for the staff that work within the pharmacy. The buyer becomes their new employer from the date of completion of the sale. And under UK law, there is a legal requirement for vendors to give prior notice of the sale to their staff and to consult with them where required. Now, obviously, one would always expect that retiring vendors will at some point in the process, but a point of their choosing, want to let the staff know of their retirement plans anyway. And in my experience, most buyers will like to meet the staff before they take over and introduce themselves and their plans for the business. But the point is that with an asset sale, there is a formal process to also undergo, and that's usually something that would need to be begun a number of weeks before the sale is completed. So again, that has to be borne in mind. There may be other third-party consents needed in order to effect the sale. For example, in our case, Lucky Star Pharmacy operates from leasehold premises, and most leases will include a requirement to obtain the landlord's consent if the lease is going to be transferred into the name of the purchaser, which is obviously something that would have to happen on an asset sale. So there will be a process to go through with the landlord in that case as well. Now, with an asset sale, I've mentioned on the next point that there's less what I call buyer risk. Where a buyer purchases the assets of a business, it doesn't generally accept responsibility or become liable for what's happened in the past in relation to the business. It's responsible for operating it from the date that it takes over. But there are more logistics involved in transacting the sale, as hopefully some of those above points will have illustrated in terms of needing third-party consents. And because of those consent processes, and in particular the NHS process, an asset sale will typically take a little bit longer to complete than the alternative, which is a share sale. So looking at that as an alternative, because the business is run through a company, Mr. and Mrs. Patel have the opportunity to sell the shares in the company to their buyer, leaving the business still in the hands of the company, which continues to operate it day to day. So in that case, whilst there's a change of ownership, there isn't a change of operation, which will generally mean that one doesn't need the same sort of consents that I mentioned just now in the context of an asset sale. So for example, if the pharmacy's NHS contract is in the name of the company, there should be no need for NHS England or the local health board in Wales to give its consent. If the pharmacy premises lease is in the name of the company, as it should be, there should not generally be a need to obtain landlord consent. There is no formal legal requirement to consult with staff. As I mentioned previously, the parties will normally want to let the staff know in any event, but the point is there's no formal process to have to undergo there. So there are less logistics, and potentially the sale can happen at a quicker pace. There is a little bit more buyer risk in the sense that when the buyer takes over the company, it does inherit whatever historic liabilities the company may have. That isn't a barrier to buyers having the appetite to buy pharmacies by way of a share purchase route. And indeed, in my experience, a lot of pharmacies now are operated through companies, and a company share sale is typically the preferred route to market. But it does mean that buyers will need to think about undertaking more due diligence, asking questions about the business and the history before the sale goes through. The last point I'd make is that there are also some tax points to consider when weighing up the merits of whether to sell via the asset sale or share sale route. And at that point, I'll pass back to Artif, who can talk to us a bit more about that.
That's great. Thanks, Tim. Now, to decide on the right structure for the sale from a tax point of view, we worked out what the Patel's estimated tax bill would be from each option, as there's a considerable difference in the tax treatment. A share sale means they'd be taxed personally on the gain and pay capital gains tax, whereas an asset sale would mean the company selling the business and paying corporation tax, and the Patels being subject to a further personal tax charge when they took out the profits. When we ran the numbers, we found that an asset sale would cost them an extra £200,000 in tax compared to a share sale, and so we recommended a share sale as the most tax efficient option. Our review of the accounts and tax position for the Patels also picked up a number of other potential issues. The layout of the accounts, although technically correct, didn't showcase the business as well as it could have. The cost of sales figure included some staff and locum costs, which resulted in a lower gross profit margin, making the business look less attractive to potential buyers. We also noticed the pharmacy staff costs had increased by 4% from the previous year and were above average for pharmacies of a similar size and location. Also, over the years, the pharmacy had been very successful and made significant profits. In fact, because the profits were regularly more than the salary and dividends taken, the company had built up significant cash reserves, and instead of leaving the money just sitting there, the Patels had used some of it to purchase a flat as an investment which was owned by the company. Finally, some years ago, the Patels transferred 20% of their shares in the company to their youngest child, Rahul. At the time, they thought he might qualify as a pharmacist and eventually take over the business. But this wasn't to be, and he ended up developing an interest in finance and studied this at university in order to become a stockbroker. Now, these last 2 points are very important as they could restrict the availability of entrepreneurs relief, or ER, on all the sales proceeds. ER is a relief that can apply when someone sells part or all of their business and means they may be able to pay a tax at a rate of 10% on the gain as long as certain conditions are met. Each individual has a lifetime limit of £10 million worth of gains that can qualify. In a share sale, the qualifying conditions are that you need to hold at least 5% of the shares, be either an employee or officer of the company, and the company also needs to be classified as a trading company. These conditions have to be met for at least 24 months before the disposal. So without ER, if the Patels were to sell their business for £1 million, they would be liable to capital gains tax at 20%, which is £200,000. But if they qualified for ER, this would be reduced to 10%, meaning they'd only need to pay £100,000, which is a huge saving. However, there are circumstances where you may not qualify for ER. For example, when you're trading through a limited company which also owns significant investment assets such as shares or properties, or which has an excessively high level of cash at the point of sale. It's crucially important to identify any problems as early as possible so you can take the necessary steps to remedy them. In this case, we were able to advise the Patels on the actions they would need to make sure they would qualify for ER when they came to sell. This involved making changes to the shareholdings and extracting the investment property from the company. Tim will be talking about this in more detail a little later on. Now, the Patels said they would like to sell in between 2 to 3 years, so we recommended they take advantage of our roadmap to sales service, which is aimed at pharmacy owners who'd like to increase the business's value before they sell. They agreed to engage us as the accountants for the business, and we got to work. Using the initial valuation prepared by Scott, we identified the key performance indicators affecting the value and looked at how these could be improved. We also looked at the issues we'd picked up in our review of the accounts and tax position and worked out the steps necessary to resolve them to ensure the Patels would get the most favourable tax treatment when the time comes. Finally, we mapped out a list of prioritised targets we wanted the business to achieve and a timeline over which we wanted to achieve them. In this case, we focused on reducing stock holding and wastage, improving the business gross profit margin, reducing relative staff costs, and making sure the sale would qualify for entrepreneurs relief. At this stage, it's also worth looking at how you can start preparing for some of the legal aspects of the sale. So I'll hand over to Tim now to tell us more about this.
Okay, so one of the main parts of the legal process of sale, aside from settling and signing the sale documentation, is, as I've mentioned, to deal with the buyer's due diligence questions about the business and its assets, its contracts, its property, and so forth. And as part of the roadmap to sell process, one of the key aspects from the legal perspective is to plan ahead for what some of those due diligence areas and questions might be, to ensure firstly that any anticipated issues can be tidied up, but also with a view to starting to gather together some of the key information and documents that the buyer may need so that those are ready to be presented when the time comes. So I thought I'd start just with a few pointers in relation to matters relating to property arrangements. The first point applies whether it's an asset sale or a share sale, and whether you've got a freehold property or leasehold property. There is generally a requirement to provide various types of certificate and property reports to a purchaser. Some are required by law, so EPCs or energy performance certificates, which have been around with us now as a legal requirement for quite a few years. And these are a certificate confirming the energy performance rating of the building that the pharmacy operates from, but that's something that would typically need to be provided. PAT certificates, which are electrical safety reports, and the equivalent certificate for gas, if there's gas within the pharmacy. Those are things that most buyers like to see, but in any event, a good practice, and certainly from an employment law perspective, is to actually renew those on an annual basis. And depending on the age and nature of the building, quite often an asbestos management report is another document that has to be provided. So it's worth thinking about obtaining those in readiness if you don't have them to hand. And if the pharmacy is a leasehold property, as is the case for Mr. and Mrs. Patel and Lucky Star Pharmacy here, there's some additional things to consider. One of the things that we like to offer to clients is what I call a pre-marketing lease audit. In other words, have your lawyer look at your lease at an early stage, check it's going to pass muster with a buyer. Most solicitors ought to have the experience of knowing what the key indicators are that a buyer's solicitor or a buyer's lender will want to see in the lease. So it's worth checking that you can tick those boxes, and if you can't, you have the opportunity to address those. Some particular points I mention here: the length of the lease that's left to run, and its renewability. A lot of business leases will have a statutory right to be renewed when they expire. Most buyers and buyers lenders look for a minimum 10-year remaining term on the lease, and for it to be a renewable lease. So that's an indicator. Also, check the lease is held in the right name. It may sound an obvious point, but we see it a lot, particularly with businesses that might have been operated initially by a sole trader pharmacist, and then it was converted over to a company, but the lease might have been left in the name of the sole trader director. That's something that would need to be corrected, as otherwise it might hold up the sale process. So do check that. And the last very important point to check is what the lease says around landlord consent requirements. I've mentioned on asset sales, there's a very good likelihood that you would need to obtain landlord consent for an asset sale and transfer of the lease. It can also crop up on share sales, company share sales. Occasionally we see pharmacies within health centres, for example, that do have a stipulation that even though it's a share sale, the landlord's consent is still needed. Very occasionally, the landlord has a right of first refusal on the sale. Also, be it an asset sale or a share sale, it's worth checking to see if the lease requires landlord consent if the tenant wants to create a mortgage over the lease. And that's very important in preparing for sale, because if the buyer, as is quite often the case, will need a mortgage to support the purchase price, the mortgage company is likely to want to take a mortgage over the property, and if that is going to require landlord consent, then it's worth planning ahead for that as well. I've mentioned preparing for the due diligence phase of the legal process generally, and the next slide gives you a flavour of some of the most commonly requested types of documentation as part of that process. So again, it is worth making sure that you have these, that they're up to date, that you have comprehensive packs of documents that can be shared as soon as the legal process begins. So employment contracts for staff, employment handbooks, which are quite common nowadays, if you have employment policy documents, grievance disciplinary procedures, things like that. Pension documents, equally important. Most pharmacies now are subject to the auto-enrollment requirements. So getting together your auto-enrollment pension documents, be they with Nest or any other provider, your declaration of compliance with the pension provider, all those sorts of documents are useful. Have a think about your key commercial contracts that support the business. For example, your insurances, contracts with suppliers of IT hardware and software, support services, particularly important in relation to your PMR systems. And while you're at it, do have a think about what the contract renewal dates are. A number of those types of contract, particularly on IT hardware and software, may be for fixed periods. And if the fixed period is going to come round for renewal right in the middle of the sale process, you need to give some thought to how you're going to deal with that. Obviously, you won't want to let the contracts just lapse, but on the other hand, the buyer may not want you signing up to new long-term contracts if it prefers to renegotiate or look to another provider once it's acquired. So give that some thought. Make sure your business records are up to date. That's an obvious one, but always worth remembering. That includes your employment records, your VAT records, your pharmacy records. Do also, if you operate your pharmacy through a limited company, give some thought to whether you as the directors or shareholders have historically had to give what's called a personal guarantee to anyone, i.e. a guarantee that your company will comply with its borrowing requirement if it's a bank, or the terms of a finance lease perhaps if you've got some equipment on finance, or indeed if you have leasehold premises, it may be that when you took the lease in the name of your company, the landlord asked you as the director to give a personal guarantee for the company's commitments. That's quite common. And it's worth identifying those, because on a company share sale, that sale of the shares in the company will not automatically release personal guarantees that you may have given. So unless you identify them and give some thought to how you're going to get them released, they will continue to apply, notwithstanding the fact that you no longer own or control the business. So that's a key one. And lastly, registrations, in particular, the NHS contract and also the GPHC premises registration. Do make sure they're in the right names. Again, we do from time to time see those in the wrong names as well. They might be in a shareholder or director's name. That can slow down the sale process if a correction is needed. So worth checking those at an early stage as well. So that's some thoughts on preparations, as it were. Artif also mentioned that in our scenario, Mr. and Mrs. Patel decided that they would, via the company, purchase a residential property investment a year or two ago with some surplus profits that were available in the company. And that brings me on to talk about another aspect that we commonly see as a feature on retirement sales and is equally relevant in terms of considering it in your planning process. It needn't, of course, be a case that your pharmacy company has acquired an investment at some previous point. It may well be that your pharmacy company, the investment is the freehold to the building that you actually operate the pharmacy from. We see that very commonly as well. And the point is that on a company sale, the seller may not want to sell the freehold to the building or the residential investment, or indeed the buyer may not wish to buy it, but the seller still wants to achieve the tax advantages of a company share sale. So they're left with having to think about, how do I get this property asset or property investment out of the company before I sell? What's the best way to do it? What are the tax implications? And that's why it's important to look at this at an early stage. There are a number of ways of extracting a property from your company, and I'm not going to cover all of them this evening, but I thought I would mention three. The first really just in passing, an option where Mr. and Mrs. Patel have pension vehicles, which Paul set up several years ago. A possibility, of course, is for the company to transfer the property to their pension scheme as part of an employer's pension contribution. There are obviously some detailed tax and pension regulatory requirements that sit around that. I'm not going to dwell on that one in any detail, other than to also make the observation that, of course, when you do contribute assets to a pension, to an extent they are locked up until retirement, which is also something to bear in mind. The two that I want to look at briefly, though, are the ones we most commonly see. So the second option is to transfer the property from the company to Mr. and Mrs. Patel as the shareholders as a dividend at the value that the company is on the company's books. Or alternatively, the company sells Mr. and Mrs. Patel the property at market value before the share sale goes through. Now, in our scenario, the residential flat was purchased a year or so ago. The company bought it for £180,000, and the flat's now worth about £40,000 more than that. It's in the territory of £220,000. So what's the best way to extract that property? So the first option is to look at the dividend. As long as the company has distributable profits, which is an accounting term, but your company accountant will be able to confirm that for you, and that those distributable profits are no less than the value the property is on the company's books, so £180,000 in our case, the company can just declare a dividend of £180,000 to Mr. and Mrs. Patel and satisfy it by transferring the property to them. So job done. The property is no longer owned by the company, it's owned by Mr. and Mrs. Patel. They don't have to pay for the property. There is a slight sting in the tail in that in declaring and satisfying a dividend, Mr. and Mrs. Patel would have to declare that in their tax return, and dividend income tax would be assessed on that dividend, and that can be quite expensive. Mr. and Mrs. Patel are higher rate taxpayers, so in our situation, their tax rate would be 38% of the value of the dividend, which is around £68,000 worth of tax. So quite an expensive tax charge there. So is there a more tax effective alternative that gets them to the same outcome? And the answer is generally yes, but it needs to be considered and planned for. And that is for the company to transfer the property to Mr. and Mrs. Patel at market value. So the company sells it to them for £220,000, which is its current market value. Again, job done. The property is no longer owned by the company. It's owned by Mr. and Mrs. Patel. They don't actually pay for the purchase price at the point the property is taken out. It's left outstanding as a director's loan. And that director's loan is then repaid by Mr. and Mrs. Patel to the company using the sale proceeds from the company sale. Those sale proceeds then end up back in the company's bank account on the day of completion of sale. And because of the way in which company share sale pricing is structured, that money effectively goes around in a circle, and a few days later, less some tax comes back to Mr. and Mrs. Patel, so that there is a neutral effect in terms of the overall net sale proceeds that ends up in their back pockets, but they've extracted the property. And the point is that whilst there is some tax, it's a much lower tax charge that Mr. and Mrs. Patel have to fund. There is a little amount of capital gains tax for them to pay, assuming they qualify for entrepreneurs relief, as Artif explained. They will have a 10% tax rate assessed on the sale price of the property, so £22,000 in our case, and there'll be a small amount of corporation tax because the company is technically selling the property at a small gain, but corporation tax rates at 19% mean they're looking at about £7,500 there. So the overall tax burden is around £38,000 less than the dividend option, which is obviously a considerable tax saving. So a few Key points to consider there: if you do have assets, and they needn't be property assets that are within the company, and you want to look at ways to extract them before the company sale proceeds. And I'll now pass back to Artif.
Thanks, Tim. Some really useful things to think about there. So, working with the Patels over the next 2 years as part of our Roadmap to Sales service, we used customized management reports to analyse and monitor the business's performance each quarter and ensure that Raj and Simran were on track to meet their targets for improvement. During this time, we also used the management reports to compare Lucky Star Pharmacy to similar pharmacies in a process called benchmarking. Benchmarking is very useful as it helps us to see how the business is performing compared to others in the market and can provide useful insights about things we're getting wrong or getting right. These management reports also help us look at how the potential market value of the business is changing as time progresses based on the most recent performance, so we can verify whether the numbers are moving in the right direction for the Patels. Now, twice a year, we review the results and re-evaluate our plan where necessary. In the case of the Patels, that way we could also factor in any changes in circumstances. For example, towards the end of the first year in June 2018, Raj and Simran decided they wanted to bring forward their decision and sell in the next 12 months, as their daughter Rikta was planning to get married. So we re-looked at our targets and timeline and amended them accordingly. The aim of this process is to increase the value of the pharmacy as much as possible before it's put on the market. It's important to remember that every £100 spent on getting the right professional advice and input can increase the profitability of your business by thousands of pounds, which in turn can increase the value of your pharmacy by tens of thousands of pounds. Now I'll hand over to Scott, who's going to tell us a bit about the marketing process.
Thanks, Artif. So Rikta, the Patel's eldest daughter getting married, is a good example of how circumstances can change quickly and why it pays to plan ahead. First thing I need to do for Raj and Simran is look at their latest figures and carry out an updated valuation to see how the business and numbers might have changed in the last year. There's a fair bit of information I'll need for the valuation, which is summarised for us here. We'd also gain some additional information about the specific trade makeup of the business, its circumstances and general potential, through discussion with the clients, and this gives us a broad oversight of the business to base our valuation on. So without all of this, it's going to be very difficult to provide Raj and Simran with an accurate value, and we'd only really be able to guess, which isn't going to be much use to anyone. We can talk about pence in the pound valuations, which I'm sure you're familiar with. That's basically looking at previous sales and adopting an average number of pence paid for each pound of turnover. Now, the difficulty with pence in the pound is that it ignores all of the unique factors of pharmacy, such as its location, rent and rates, staff salaries, and profitability, all of which can vary hugely. So because of that, we can never rely on pence in the pound alone as a methodology, and it can only be used as a guidance tool when the profit multiplier method doesn't reflect quite what our gut tells us. I've tried to demonstrate with the slide here just how many factors can affect pharmacy value, and this is not an exhaustive list, but I just wanted to run through some of the principal ones with you here today. So firstly, we have high levels of counter sales, private scripts, care home or docet items. Now, these can sometimes detract from a pharmacy's value, and it's all to do with risk and security of the income. If these incomes make up more than about 10% of turnover, or 25% for OTC, it can be seen negatively by the market. Traditionally, the higher the NHS proportion, the better the business is perceived by buyers. Then we have premises costs. Now, these are likely to be your biggest business expense after wages. A lower rent and rates cost means for higher profit, and that allows potential for higher goodwill value. In addition, if the freehold is available to buy with the pharmacy, or if you can be flexible in offering a lease or freehold option, it can make the business more desirable overall. And in a competitive bidding environment, you could see higher offers received. So we have surgery moves. So whether these are planned or rumoured, they will generate concern around the continuity of the business. And we continue to see large-scale health hub developments popping up here and there, despite the austerity, and also a lot of single doctor practices closing their doors. In those kind of circumstances, quite often the patient lists are merged by the CCG, and that means it's uncertain who's going to secure those scripts going forwards. EPS nominations are helpful in these instances, but it doesn't remove the risk altogether. And we have high wages and overstaffing, and this is quite prevalent in retirement sales, with pharmacy owners at the end of their careers taking more time out of the businesses. Sometimes staff hours can be reduced to lower overall costs, but at the end of the day, no one wants to make redundancies, and that includes your buyer. Location. So this also affects price. Large cities away from coastal areas tend to generate higher prices because generally there are higher concentrations of buyers living or looking to buy there. As well as regional variations, there's also national level variations, large premiums being paid for Scottish and Welsh city pharmacies compared broadly with English prices. This is partly because there are less pharmacies in Scotland and Wales, and therefore less supply for the market, but also because the funding outlook is more positive than in England. We have business potential. So when you're approaching a sale, generally it's a good idea to leave something on the table for the incoming owner to develop and make their stamp on. There is a risk that if you've left nothing for a buyer to grow and develop, you could actually see less interest and a lower price achieved. Then we have presentation of your financial accounts. Now you need an accountant who's experienced in pharmacy, who can present your figures clearly and demonstrate the profitability of the business in its best light. Artif's already mentioned having locum costs in the correct place, and this goes for wholesaler rebates too. Otherwise, your gross profit margin as a percentage can appear lower than it actually is. In the years running up to your sale, you should try and keep any personal expenses to a minimum. And overall, if you've got decent accounts, it should inspire confidence from buyers and lenders. And that in itself can help to generate more offers, but also less questions and stress for you during the sale process. So these few points we've run through are the more general factors to consider across the board. But the single biggest factor we saw affect the market in 2019 was the increase in supply. During the last 2 years, there's probably been in the order of a 60% increase in pharmacy numbers brought to the market. And this is principally as a result of the government's funding cuts and cash flow difficulties. A fair proportion of those pharmacy sales have been multiple operators who've been offloading shops that are problematic, low profitability, low turnover, or geographic outliers. The cuts in funding have really bitten from the market's perspective in the course of last year, as operators received their 2019 accounts. And in a lot of cases, there was a reduction of around 2 to 3% in gross profit margins compared with 2018 figures. Additional factors have contributed towards that fall in margin, things like category M clawbacks, shortages of some key drug supply lines forcing prices up. And most of these are temporary factors for the market, and that includes the increase in supply we've seen, which will eventually fall off. But there has been a noticeable fall in operators' pre-tax profits, and that has inevitably affected the valuations we're seeing. So the good news, however, and there is some, the banks are still keen to lend to pharmacy, and we've even seen some new lenders and private equity groups enter the market, which is encouraging. Uncertainty has forced some buyers onto the sidelines, but there are still significant numbers of buyers out there mopping up this additional supply. And this includes group operators and first-time buyers who've remained out in force, and generally they've got significant cash funds, quite often from family to invest. The approach from buyers at the moment is a more cautious and strategic one, but the appetite to grow and acquire still remains. Where pharmacies have reported more significant reductions in profits, in some cases we've seen buyers apparently stretching the valuation multipliers higher. But this appears to be an indirect result of them shifting weight slightly back towards a pence in the pound valuation approach. In this climate, it's more important than ever that you're focusing on the business, planning ahead, operating as efficiently as you can, and presenting your figures in the most positive way. And this is so that you can squeeze every pound of value from the business and keep those pounds in your pocket, not the taxman's. This market, like most, tends to operate in cycles, and when goodwill prices fell in October 2007, following credit crunch and the big category M clawback, it took about 7 years for the prices to peak again. It's clear to everyone by now that pharmacy is changing and that contractors need to change with it in order to be successful. For those that were thinking about selling but have decided to hold off, it's prudent to use that time planning and preparing for a sale so that you can make the most of it when it comes around. If you've had a valuation carried out that's highlighted potential issues such as planned surgery relocations or closures, you need to decide before marketing whether it's possible to resolve the matter, wait it out, or reduce the perceived risk by finding out more information. If that's not possible, then you should be upfront with your potential buyers. In some cases, a collaborative approach can be conceived that helps both parties to achieve their goals. And in any case, these kinds of issues do tend to come out in the legal due diligence. And if it's left to that stage, trust is going to be lost with your buyer, which can spell disaster. Coming back to our case study on Lucky Star Pharmacy, when Raj called me in June to bring the sale forwards, I knew that Artif had already helped improve matters from a valuation perspective. He mentioned earlier that he tidied up the structure of the account, so let's take a quick look. On the left here, we have the old accountant's figures, and on the right are the 2019 accounts in updated format incorporating Artif's changes. Now, these make it far easier for buyers and lenders to assess the business more accurately. You can see the difference in margin demonstrated in red and achieved through moving the locums to expenses rather than having these sit in the cost of sales. Now, together with the targeted work that Raj and Simran have been doing in the pharmacy, the numbers for 2019 look a lot better too. We can see that the gross profit margin is up to 32.05% in 2019. And also the profit before tax at the bottom is up by 50,000 to 138,693. Now, this is in part due to the Patel's efforts to control and reduce their wage costs. Now, in any pharmacy valuation, gross profit and your buying is the single biggest factor that determines the price you'll receive. And a relatively small improvement here can make a very big difference to the price you walk away with. And we'll take a look at that in some more detail shortly. When I carried out my first goodwill valuation of Lucky Star Pharmacy in 2018, Raj and Simran had a salary bill that was just over 17% of their turnover level. And they've now managed to reduce this to 15.9% for the 2019 figures. As a rough guide to staffing costs, we'd hope to see a figure somewhere close to 15% of turnover. That's including pharmacist costs. And that would represent pretty tight cost controls for a pharmacy similar in trade to Lucky Star. If the turnover was lower, something say 750,000, then we'd expect to see the relative percentage increase. And that's because there's a minimum staffing level that you can operate any pharmacy business at. Similarly, if Lucky Star was carrying out a lot of labor-intensive work, such as nursing homes or dossett boxes, then again, we'd expect to see a higher percentage. So here's a quick recap then of the improvements Raj and Simran have made since my first contact with them. So we've got a clearer set of accounts. It's hopefully more appealing, and it's going to inspire some more confidence from the market and lenders. We've improved on the gross profit margin, which has added £30,000 to the bottom line, and we've made some significant reductions in the wage bill as well, which has added an extra 14,000 there as well. If we now look at my valuation workings, you'll see how the two compare. So my first valuation from 2018, that's based on the old accounts, is on the left, versus my latest valuation using improved figures for 2019 on the right. Now, in the expenses for 2019 on the right, you can see that Raj has shopped around and he's managed to shave about £1,000 in total from his insurance and energy bills. It may not sound like a lot, but any savings to expenses that you can make is multiplied several times by the market to arrive at an offer. Recent sales stats showed us that the average profit multiplier in London is around about 9 times currently. So Raj and Simran have the potential here to turn that £1,000 saving into £9,000 goodwill, which would be a great result. Coming back to gross profit margin though, using the figures here, you can see why your buying and stock control is so important. As a simple example, on a £1 million turnover pharmacy, every 1% increase in gross profit margin is going to add £10,000 to your bottom line. Now, if you apply a reasonable multiplier of 8 times, that becomes £80,000 in goodwill. It's vitally important then that you don't lose enthusiasm and become complacent with your buying, because similarly, every 1% margin that you lose has the potential to reduce your price by a similar amount. Now, before I can arrive at a true EBITDA figure that we'll use for a valuation, there are some adjustments that I need to make to the numbers that we'd see in the year-end accounts. Now, on the right-hand side here, you can see that I've added back depreciation, as this is not a real cost for buyers. I've also added back directors' remuneration, and that's because I've already accounted for a full-time pharmacist salary and locum cover at the top of my expenses. Part of that director's remuneration was a salary paid to the Patel son Rahul. That's for his time during holiday periods, so this can be wholly discounted, along with the rental income from the Patel's investment property, since this has now been removed from the company. If there were personal costs in these expenses, such as directors' vehicles or one-off property repairs, then I'd look to remove those as well, but Artif has worked with Raj and Simran to remove these items and the personal cars from the company, so we're left with true expenses that reflect just the pharmacy trade. Now, the EBITDA figure for 2019 can be seen at the bottom there at 146,261. If we compare that with my previous valuation, the best that I could get this up to was 100,000. Now, that difference in profit for 2019 adds about 350,000 to the business value. And I've applied a multiplier here of 8 times based on the location and market comparables. This suggests a value for us in the region of 1.2. I'd also considered what that represented as a pence in the pound value, because this does tend to act as a bit of a cap and floor for prices. So with just over 1.2 million of turnover, this does of course equate to 100 pence in the pound, £1 in the pound. And having considered all other factors in and around the business and market, I felt this was a good place for the Patels to start the marketing process off. Now, you may be wondering why I've used 8 times in that process and not 9, if that's the average that we've seen. Well, we have to be careful in the marketing stage not to scare buyers off. Getting them to digest the information fully and generating viewings is essential if we want to demonstrate the full potential of the business and encourage offers. If you pitch price too high, particularly in today's market where there's more choice and risk for buyers, you could struggle to generate a competitive bidding environment. And it's this competition, having multiple parties to negotiate with, that allows us to achieve premium prices for sellers. That's how you might hit the 9 times multiplier. But the competition also helps us to secure better terms of deal for our clients, things such as a higher holding deposit or shorter timescales to completion. So where does Raj and Simran's sale go from here? Well, let's just take a quick step back and we can look at the process in general. So once we've carried out the valuation and the client is in agreement, we need to devise a strategic marketing plan. It's strategic because each pharmacy is unique, and we need to think ahead in the context of this one's specific circumstances. We need to identify critical areas, any positives, any negatives, and we need to have a plan in place for dealing with all of it that leads to the best possible outcome for the seller and avoids unexpected issues or unnecessary exposure. Now, there's a number of areas that we would need to consider, but I'll concentrate on the key ones this evening. So firstly, we have pricing of the business for market. Now, this we've already discussed is crucial to success, now even more so with greater number of pharmacies on the market. If a potential buyer has dismissed the opportunity based on its headline price, it's a very difficult position to get yourself back from. And rather than marketing the business a second time at a reduced price, you're far better to get this starting position right the first time. Timing of the marketing. Now, this of course includes avoiding holiday periods, but whether it's a good time to sell generally. And I think a lot of you are probably wondering this right now. Well, during the last few years, there's been significant political disruption with Brexit and the election, all of the contractual changes to pharmacy, a lot of uncertainty generally, and a marked increase in supply. And of course, all these factors combined have put a bit of pressure on the prices. By and large, though, those prices are still good if you consider that the EBITDA multipliers are still being achieved above the 5 to 7 times formally quoted by banks and lenders. On that basis, we should still consider these to be premium prices. Looking forwards, unless there's an increase in the profitability at the regulatory level, which could be difficult given that we're now into this 5-year funding arrangement, it's unlikely that we'll see the goodwill prices suddenly jump up. There are a lot of factors to consider here though, not least of all your personal circumstances, and none of us know what's going to be around the corner. Based on what we can see though, we do expect prices to settle as the number of pharmacies coming onto the market inevitably slows down. And we might have seen the beginnings of this in the last few months. Another strong factor, of course, is entrepreneurs' relief, since this is currently worth a significant amount to qualifying business owners. And there has been a lot of speculation that the government will make changes to this in the budget in March. In fact, it was included in the Conservative manifesto. Is it still a seller's market though? Well, there's been a shift in the power. It's fair to say that. The market is more balanced than we've seen in the past, but the demand is certainly still there. It just becomes slightly more of a challenge to find the right buyer. Stats over the last 2 years have shown the average number of offers received across the board fall from 8 to 4, but that number still provides for a competitive bidding process. And all things considered, we'd say it's still a reasonable time for anyone thinking of selling. In terms of timelines, how long your sale takes will vary depending on whether it's an asset sale or a share sale, leasehold or freehold, and perhaps depending on the structure of your company. There will be differing legal requirements depending on all of those circumstances. Your accountant may also advise you to target a specific date of completion for tax purposes or to benefit from certain tax reliefs. On average, we're seeing sales taking about 8 months at the moment from instruction to completion. In the Patel's case, fortunately, there's no transfer of ownership required for the pharmacy license. This is because it's a share sale. And as Tim mentioned, it saves the problematic exercise of dealing with the NHS applications alongside the sale of the business. Then we have a presentation of the business for market. So before we contact anyone about the business, we need to decide what are the key selling points, and the sale particulars themselves need to be structured carefully to reflect any future potential. If profitability is unclear, then we can also include an adjusted profit and loss account in the particulars, demonstrating any adjustments a buyer should consider in order for them to understand the true profitability on which to calculate their offer. If there are any issues or matters that need to be disclosed to potential buyers, then we need to have a think about the best way to present these too. Depending on the nature of the situation, that may or may not come into the sale particulars themselves. We can sometimes take a different approach and discuss matters directly with the interested parties. So on to confidentiality. Most of the pharmacy sales we deal with here are totally confidential, and all of our company processes are geared towards this. Confidentiality is naturally balanced against maximum exposure when you're undertaking the marketing exercise. And our skill comes into play because we know the market and the buyers extremely well, and we're in a position to approach the selection of the best ones from our database in the first instance. And those are the ones who we know are looking for that type of pharmacy in that particular area. And this, along with having all of our buyers sign confidentiality agreements before they receive any details, helps us to achieve maximum price for sellers with a measured level of market exposure that best maintains that confidentiality. So then for the offers process, before an offer is accepted is when the seller is theoretically at their strongest position of negotiating power with buyers. So to take advantage of this, the process requires some careful thought. We need to ensure that key terms are included, such as cash balances being structured as part of the deal, and also buyers being made aware of any issues. Crucial information should be presented to buyers in advance so that we can avoid any issues at the legal stage. And care also needs to be taken to ensure the interested parties understand the process ahead of them and what will be required. An important point here is to ensure a holding deposit is paid by the buyer at the outset of the legal work, protecting the seller from frivolous offers and unwarranted price chips. Building in a second round of offers to the process allows the opportunity to negotiate a higher price, as well as other favourable terms in a bid to improve the seller's position and reduce their risk. It's equally important that offers are presented in clear and specific words to avoid any misunderstanding between the parties as to what the offer actually includes. This is most important with company share sales, as there's a process called the net current asset adjustment. This is applied to the goodwill price, and it's a common area of confusion for both sellers and buyers. Artif and Tim are going to touch on this again shortly. In addition to a party's willingness to pay a holding deposit, we'd also want to see proof of funds before considering the offer seriously. This usually consists of bank statements, company accounts, or correspondence from their accountant, broker, or bank. The important thing to consider is what the bank's valuation of the business is likely to be, since the lender will typically contribute around 80% of that figure, and any expected shortfall between the loan and offer amounts will need to be topped up from alternative funds. There are some banks out there currently offering up to 95% of valuation where a freehold is involved, and this is particularly helpful for first-time buyers. So how did we market Lucky Star Pharmacy, and what were the results? So when I visited the pharmacy and I met with Raj, he raised a concern about the appearance of the shop, as it was looking a little tired, and he asked a question that's often raised with us, which is whether he should refit the pharmacy before putting it on the market. Now, my advice to Raj at the time was that he'd be unlikely to see that investment returned in any goodwill offers from buyers. And this is because the offers are primarily based on the profitability of the business. Leaving the refit to the buyer also adds something for them to put their stamp on, so we agreed to leave that and push ahead. On the marketing front, Raj and Simran were happy to proceed at offers in excess of 1.2, and we approached a targeted group of top buyers from our database. We marketed the pharmacy for a period of 10 weeks, and following viewings, we received offers from 2 first-time buyers and 1 group operator over the course of 2 rounds of offers. With multiple parties involved, during the second round of offers, we were able to negotiate a higher best and final position of 1.25 million from the preferred party. And that came with a holding deposit of 30,000 for Raj and Simran, and that's 10,000 more than our minimum level. And that just gave the Patels a sense of added security and confidence. The successful offer was from Smith & Sons Pharmacy Group, an independent operator with 6 branches that border North London from the east. Raj and Simran felt that Smith & Sons had a similar ethos to them. They'd be a good fit for the business and would take good care of the customers that they'd built up over the years. We then drafted comprehensive heads of terms for the deal, which we circulated between the parties and their advisors. We also worked to secure the holding deposit as quickly as possible from the buyer so that we could get the legal work underway. At this point, Artif and Tim start to get more heavily involved again, and Artif's going to take over the reins for us now as the legal process kicks off.
Thanks, Scott. Now let's talk about what happens once you've found a buyer. The next step is the due diligence process that Tim mentioned earlier. Once Smith & Sons had paid their deposit, they started the due diligence process and their accountant requested a list of information about the company. As this was a share sale, they wanted to go back over several years so they could be as comfortable as possible about the history of the company. As we'd now been working with Raj, Simran and Lucky Star Pharmacy for the last 2 years, we'd improved the quality of their record keeping and their bookkeeping system for the business, so we could easily get everything over to the buyer's accountants in a clear and consistent format. They could then go through the information provided and satisfy themselves that everything was in order and there were no hidden skeletons in the closet with a minimum of effort. While Smith & Sons accountants were going through the due diligence information, their solicitors produced a draft share purchase agreement. This was sent to both Tim and us to review, and here's Tim to tell us more about it.
Thanks, Artif. So, company share sale agreement comes through. I thought I'd just touch on what some of the key aspects of the actual sale document will cover, just so that you have a flavour of that. Obviously, price being the most important. So Scott secured them an offer of £1.25 million for goodwill. Scott mentioned that there's then an adjustment to that for what's called net asset value, which is something that Artif's going to come back to in a minute. But just very briefly, essentially the 1.25 million headline price is for the goodwill and the fixed assets of the business. So the fixed assets are the physical assets apart from the stock, fixtures and fittings essentially. And then in addition, because the purchaser acquires the company and everything that the company owns at the point of completion, that's going to include the value of its stock, whatever cash it's got in its bank account, whatever money the company is owed by its creditors and by the NHS and by VAT man if it gets VAT refunds. So there's various assets that belong to the company that have a value, and those need to be added to the price. But from those, one also, in the similar token, deducts whatever the company's creditors and liabilities are at the point of sale, including a provision for tax on its year-to-date profits. So one takes the creditors and the liabilities away from the assets, and what you're left with is normally positive, unless you've got sizable borrowings in the business. And that positive sum is added to the 1.25 million pounds. And if you've got a negative figure, it's deducted. And the actual amount is worked out by way of a set of accounts for the company, calculated at the completion date, but normally produced in the months following completion. So there is that completion accounts pricing adjustment. There's also another important part of the document, namely the warranties. Warranties are basically statements or promises that the sellers will be giving to Smith & Sons as buyer, covering a range of matters. They're quite standard, both tax and non-tax warranties. So things like whether the company owns all of its assets, whether the company has complied with legal and regulatory requirements when running its business, is the company involved in any litigation or complaints from patients or insurance claims, and has it been in the past? Warranties around the accuracy of the financial data that the buyer's been provided with and against which it's made its pricing offer, including the historic accounts for the company and its tax affairs, and some more generalized warranties around tax and tax compliance. And those are all quite standard. They're a key area for review as part of the legal process, because obviously you as sellers will want to ensure that the warranties are correct, because if they're not, and the buyer suffers a loss because they're not correct, that's where you may be in a hopefully unlikely situation of being presented with a claim and having to hand some money back, which is not where you want to be. So those are always carefully checked, and part of the legal work is to go through that with you. And where there is anything of relevance to disclose in any of those areas, a disclosure is made. It's typically in the form of a letter which accompanies the sale contract. And again, your legal advisors need to be closely involved in that to make sure that you've covered off everything and you can walk away at completion knowing that you've disclosed whatever's relevant, and the risk of any claims or price refunds are as reduced as they can be. It's the peace of mind factor. Another important aspect with company share sales is something called a tax covenant. Again, they're quite standard, because the buyer, as you may remember I mentioned before, inherits the company with whatever liabilities it has at the point of completion. Those could include liabilities for historic tax from aspects that have happened in the past before the sale goes through. So if there are tax liabilities relating to the past which haven't been paid and which don't get taken into account as part of the completion accounts adjustment to the price, then if those liabilities relate to pre-sale periods, they will ultimately be the responsibility of you, the sellers, to pay, should the taxman pursue those after the sale's gone through. Now, there will usually be some protections in the contract around that aspect, including your ability to say, if the taxman has come up with some sort of claim, the ability to say, well, that should be disputed, doesn't sound quite right. So it's important to ensure that there are some limitations or exclusions of liability on your part as sellers that are also written into the contract. And again, these are quite normal and should be in there as a matter of course. They would include things like a time period for the buyer to bring a claim if it feels it has one for a breach of a warranty or a tax claim. And typically, time periods for claims tend to be anything up to about 2 years. If it's not a tax matter, quite often up to 7 years for tax, because that's the window that HMRC have to launch an investigation or an inquiry. I hasten to say I've been buying and selling pharmacies and asset and share transactions for 20 years. It's very rare to actually see a claim, but obviously buyers always look to make sure that they're covered, and it's important to make sure that the process is properly gone through for you as sellers. And the last point, just to mention, restrictive covenants. What are these? Well, Mr. and Mrs. Patel are going to trouser £1.25 million on completion, hopefully another payment when the completion accounts come through. They're retiring. What Smith & Sons won't want is for Mr. Patel to pop up 6 months down the line, round the corner in another pharmacy, and for the patients that he's known for the last 30 years to think, fantastic, he's back. I'll transfer myself to his pharmacy and we'll go down there. That's obviously not going to work for the buyer because part of the goodwill is the relationship with the patients and the volumes that are generated through the business. So it's quite normal that sellers will commit not to do anything in a competitive sense for a period after the sale, and that includes being involved in a nearby pharmacy, applying for a new pharmacy license, although they're like gold dust and very difficult to get. We do still see those being granted, and also perhaps not soliciting patients to move away to another branch, things like that. And typically the period of the restriction will be for maybe 1 or 2 years. One thing that we often find sellers do want to do within that is retain the ability to still provide some locuming in the area. It's particularly the case if, as is the case with Mr. and Mrs. Patel, they've been involved with the community for that long. There is a sense of allegiance felt to the local community, and being able to provide locum services is a way of stepping back from things in a more graduated way, I suppose. So that's something to think about, and just an illustration of some of the key areas that the sale document will cover. And I'll now pass back to Artif.
Fantastic, thanks Tim. Now, as accountants, our job was to work alongside Tim and his team to go through the share purchase agreement with a fine-tooth comb. We needed to check exactly what Raj and Simran would be agreeing to by signing it, suggest any changes as the main terms and covenants where we thought the conditions were unfair on them, and to carefully go through the warranties to make sure the buyers were made aware of any exceptional events or circumstances. Because pharmacy is all we deal with and we see plenty of sale agreements in the course of our work, between our two firms we know what's appropriate and what is excessive to warrant. And so with our combined experience, we were able to limit the Patel's risk and make sure they were as protected as possible. The sale agreement sets out how the seller is to be paid for the net assets of the business, in addition to the payment for goodwill. Once the target date for completion has been agreed, we need to provide the buyer side with a figure for the company's estimated net asset position at the completion date. This is made up of the company's assets, which are things it owns or is owed, like cash, stock and debtors, minus the liabilities, which are things it owes out, like money owed to suppliers or HMRC, but excluding fixed assets like equipment or shop fittings. Of course, we're unable to provide an accurate figure at this point because we haven't reached the completion date yet, and in any case we wouldn't have access to statements from the NHS and suppliers, as they won't be available till some time after completion. So we estimate this as best we can. This estimate then gives the buyer an idea of the net current asset payment they will need to make, in addition to the payment for the goodwill and fixed assets. Once the completion accounts have been prepared and agreed by both parties several months down the line, a final payment can be made for the actual amount due as per the accounts. When we reviewed the sale agreement, there were a number of things we picked up. For example, we felt the proposed method to calculate the net current asset figure was unfair, as it included deferred tax as a liability to the company, and this reduced the additional payment due to the Patels. We went back to the buyer's solicitors on this point and asked them to change it. They were reluctant at first, as they said it was standard practice for pharmacy sales, but we were able to explain our rationale for excluding it, and eventually we got their agreement, which meant the Patels were £14,000 better off. The agreement also set out the terms by which the business would produce the completion accounts and what the procedure would be if the accounts were not agreed by the buyer. The time frame for us to produce the accounts stipulated by the buyer was quite tight in the agreement, as they wanted us to send them within 3 months. We knew from experience this could be problematic, as we wouldn't be able to complete work on the accounts until we'd received all the relevant information, including the NHS FP34 statements, which wouldn't be available until 60 days after the completion date. So we asked for the period to be extended to 4 months, which was agreed by the buyers and ensured the Patels would not be in breach at this point. We also went very carefully through the tax warranties in the agreement and cross-checked them with the company's accounts for the last few years to produce a list of any facts and circumstances that needed to be disclosed to the buyer. And these were then collated by Tim and his team in the disclosure letter. The tax warranties are very detailed and refer to numerous statutes from tax and company law, so it is essential they're looked at by an experienced accountant familiar with your business and with pharmacy sales. Putting the time in to get this exercise right meant the Patels could sign the agreement with peace of mind and confidence that their interests were protected. Now over to Tim to tell us more about some of the issues that came up on his side.
Thanks, Artif. So this is my final section, and I thought I would just talk about 3 or 4 points that are quite interesting that we often see crop up in sales, and I've sort of woven them into the tapestry of our scenario here. So you may remember that I flagged the need to check whether on a company sale you've given a personal guarantee as director shareholder for your company on the premises lease. Mr. and Mrs. Patel did. The other thing that cropped up for Mr. and Mrs. Patel is that when they signed their pharmacy lease, it was a 15-year lease with 5 yearly rent reviews, and the last rent review date was 12 months ago, but the landlord hasn't implemented it yet. So in terms of the first point and the personal guarantee, obviously Mr. and Mrs. Patel would prefer to see that released by the landlord at the point they sell the company, so that they're no longer on the hook for that should Smith & Sons fail to pay the rent on time. There was a concern though that if we approached the landlord explaining that the company was being sold and asking for a release, and maybe Mr. Smith as the director of the buyer to go on instead, that the landlord would see there was an opportunity to perhaps use that as leverage to secure a rather more favourable rent review outcome than would otherwise have perhaps been the case. So we had to consider what was best to do tactically, and in consultation with the buyer, the view taken was actually not to approach the landlord, because we felt that was quite a substantial risk. So we came up with an alternative strategy. So we left the personal guarantee in place at completion, and we didn't approach the landlord. And we agreed with Smith & Sons that after the sale had gone through, they would approach the landlord, confirm that they'd purchased the company, and open a negotiation to put forward a replacement personal guarantee on the lease. And alongside that, of course, a commitment from Mr. and Mrs. Smith as the owners of Smith & Sons to Mr. and Mrs. Patel, that if for some reason their company didn't pay the rent or comply with the lease going forwards, and if the landlord came to Raj and Simran and said, give us a check, that they could immediately ask Mr. and Mrs. Smith to write that check back to them. So that was the solution there. And on the rent review, what was agreed is that if and when the landlord invoked that, no steps would be taken to agree any revised rent unless both Mr. and Mrs. Patel and Mr. and Mrs. Smith agreed, and everyone would use their level best to minimise the amount of any rent uplift. But obviously there would be an arrangement for the cost of any rent uplift to be shared between the buyer and the seller, because of course the rent uplift could be backdated to the original rent review date, which was a year prior to the sale going through. So there's a couple of interesting points there, and they are things that we regularly see come up. Another point that's quite often raised, and certainly has been in recent times, by buyers is around NHS clawback charges. And in this connection, I'm talking about clawback charges imposed by the Department of Health and NHS England and the Welsh equivalent generally on pharmacy. I'm not talking about instances where a particular pharmacy has overclaimed for payments that it shouldn't have received and there's a clawback. That's a slightly different point. A good example of NHS clawback in recent years would be the Category M clawback charges that Scott mentioned a little bit earlier in his section. Although we're currently in a phase of moving away from NHS clawback on Category M, and potentially even to some Category M charges being returned, it's been a fairly common feature in the last couple of years that buyers have looked to try and have an arrangement to adjust the price they pay for the company after the sale's gone through, if within the following, say, 6 or 12 months, the NHS announce a further round of clawback. And I'm often asked, well, what's the fair approach there? And I tend to take the view that because this is clawback that affects UK pharmacy generally, and because clawback is dealt with by adjusting the drug tariff rates, for example, for Category M products, for Category M clawbacks, but there are, of course, a whole myriad of other drug tariff rates, then clawback charges really shouldn't be treated as a special case. They should be treated in the same way as any other business overhead. So in the same way that business rates can go up, insurance premiums can go up, wages costs go up, so too can drug tariff rates. They can also come down. So in a sense, it should really be a point for buyer risk and buyer reward, rather than something that the buyer can come back and have another bite of the cherry after the event on price. And we regularly get involved in that debate, but I have to say in my experience, most buyers tend to accept that point and don't make too much of an issue of it. But it's certainly worth not just automatically giving way on, because it could have a fairly dramatic impact on the ultimate price that you receive as a seller, of course. And then last point, briefly, really just to close the circle on my point from earlier around cash that's in the company at the point of completion, which you'll remember I've said is part of this net asset value calculation and the completion accounts. Quite often we find vendors with companies that are being sold where the company's got quite a bit of excess cash in the books at completion, maybe because the sellers have bought an asset off the company like the Patels did here, or indeed a lot of sellers take tax advice and decide not to take dividends in, say, the last 12 months run up to the sale because they don't need the cash and they'd rather get the cash out as part of the sale price at a 10% tax rate rather than paying dividends. Nothing wrong with that. The point that Atif made earlier is relevant in terms of if you've got a serious amount of cash, you know, disproportionate value of cash as opposed to the other assets, then be careful because you might lose entrepreneur's relief. But quite often when we see this situation, a buyer will have a natural reluctance to want to pay cash for cash, which is effectively what they're doing in leaving the cash in the company and paying for it through the net asset value. And they instinctively say, well, the sellers should take out the excess cash, take a dividend, and we'll pay for the working capital cash in the usual way. And I'm always at pains to say to sellers, well, don't just automatically accept that. It doesn't make much sense. Obviously, any cash that Mr. and Mrs. Patel take out, so in our example, there's going to be 220,000 of cash sat in the coffers on the day of completion, they're going to pay dividend tax on. So at 38%, that will cost them 83 grand. What's the problem for a buyer paying cash for cash? is the question I usually ask, to which there is the answer is usually, well, actually there isn't one. There's no cash flow cost to the buyer because it's self-funding. They bought a company that's got cash in it. A couple of days after they bought it, the cash can be moved back to the vendors. The only real cost to the buyer is a fairly small tax cost, in the sense that the buyer pays a form of tax called stamp duty on the overall price it pays, which includes obviously the cash element. But the stamp duty tax rate is 0.5%. It's nothing near 38%. So, you know, if 220,000 of cash is in the company at completion, the buyer's going to pay £1,100 of tax if we do the cash for cash route, which Mr. and Mrs. Patel, I think, would be very comfortable saying, fine, I'll cover that cost for you, Mr. and Mrs. Smith, because the alternative costs me 83 grand. And we usually get a successful outcome on that. As I say, it shouldn't really be a bone of contention. So certainly don't feel obliged to have to take out excess cash if you're in that sort of situation. Do take some advice. So that's my last point, just in terms of issues that crop up. And now back to Artif, I think.
Thank you, Tim. Now that brings us to the point of completion. When the buyers were happy with the results of the due diligence exercise and the sale agreement was close to being agreed by both parties, a completion date of 31st of July was agreed for ownership of the pharmacy to transfer from the Patels to Smith & Sons. It's generally helpful if the completion date can be at a month end, as this makes it much easier to calculate the position at the point where the business is transferred. Once both parties had agreed on the wording of the sale agreement, we were all set for completion. On the day, the sale agreement was signed and the shares transferred. Payment was made to the Patels and the pharmacy officially changed hands. The next thing we need to consider is the completion accounts. Fast forward a couple of months from completion. The Patels were settling into retirement and we finally received the NHS dispensing statements for the month of completion. And with this, we could get to work on finalising the accounts. These need to be prepared with extra care and attention to detail to make sure they represent the closing position of the business as accurately as possible, so you can benefit from all the profits from your period of ownership without paying for any of the business expenses from after this date. Once we'd prepared the accounts on this basis, they were sent to Smith & Sons accountants, and under the terms of the sale agreement, they had 20 days to inform us of any disputes or to accept the accounts. After reviewing the accounts, Smith & Sons accountants sent us a list of payments made by the company after completion that they believed were incurred before completion and so should have been included in the completion accounts. We went through these with Mr. Patel and eventually agreed that 2 of the invoices were related to his period of ownership and so should have been included in the completion accounts. We revised the accounts accordingly and these were finally accepted by both parties. Smith & Sons then released the final balancing payment for the net current assets in accordance with the share purchase agreement, which meant the Patels had now received full payment for their business. The final step is declaring the sale on your personal tax return and calculating and paying the tax due. As the sale had completed on the 31st of July 2019, it fell in the tax year ending 5th of April 2020, and so would need to be reported in the Patel's 2020 tax returns. These will need to be submitted and the tax paid by the 31st of January 2021. The Patels have received a total of £1,825,000 for their business and its assets and paid professional fees of £70,000. So their total gains from the sale were £1,755,000. And the capital gains tax due on this after the application of their annual allowance and entrepreneurs relief was just over £173,000. This is hundreds of thousands of pounds less than they would have to pay if they'd structured the sale as an asset sale or extracted the surplus cash before the sale, or if they'd failed to qualify for entrepreneurs relief on all the sale proceeds. Once we calculated the tax bill, we were also able to advise the Patels on ways they could reduce it. Another important area they needed to look at was estate planning. The Patels had already written their wills with Paul's help, but they needed updating. Fortunately, Charles Russell Speechleys were on hand to assist with their will writing service. We also advised the Patels on their exposure to inheritance tax, or IHT. When they owned the business, they could benefit from business property relief, or BPR, which means if they were to die, the business assets would be outside of the scope of IHT. But once the business is sold, BPR no longer applies, and their share of the cash proceeds would be liable to IHT if either of the Patels were to pass away. Again, working with Paul, we could present options to mitigate this risk. We'll also be hearing from Paul shortly on how he advised them on investments they could make for an income in retirement. Apart from that, they just needed to decide what to spend the rest of their money on. At the end of the day, the Patels were overjoyed that they'd managed to sell their business quickly and with a minimum of stress, while receiving a higher price and paying less tax than they had expected. And now over to Paul with more details of his advice to them.
Thanks, Artif. So if you remember 25 years ago when I first met the Patels, we just literally set things on their way. So we started off with a small regular premium for their pension, small regular premium for their ISAs. We helped them buy their first house. We helped them take out their first mortgage. We helped them do their first wills. And obviously at the core of all this was providing them with financial protection. So the what if scenario, what if they die, what if they get ill? So every year when I went back to visit them, we talked about the spare income, and the premium into their pension went from £50 to £100 to £500. And then certainly in the latter years, we got the limited company to pay contributions of up to £40,000. And the real benefit there, of course, is the company receives full corporation tax relief on that. So extracting money from the business for their own personal benefit, as well as saving tax. So every year we talked about paying money into ISAs and the most tax efficient way to save, whilst also protecting them and upsizing their house as we went along. So this is what they've ended up with after 25 years of receiving good ongoing financial advice. So the cash from the sale of the business, I'll come back to pensions, but worth £1,055,000 each. They had ISA plans worth £300,000, a couple of buy-to-let properties, some cash in the bank, and their maiden residence was worth £1 million, and they had no debt whatsoever. So just going to touch on pensions very quickly, because this is probably the most topical area that we deal with. So pensions now, in the past, were seen as quite boring, and not many people wanted to have a pension because they were very restrictive of what you could do. But now I've used £1,055,000 because that is the maximum amount of money you can have in a pension pot without having any taxes due. So that's the limit you can get your pot up to. From that £1,055,000, you are able to extract 25% of the fund value as tax-free cash, and the remainder you are free to take income from it as you see fit. So you can take some, all, or none of it. But probably the most powerful thing is, certainly in the Patel's case, is if they didn't need the money from the pension, it is very much like a family trust. So the money, if they don't need it, and should they die, can be passed on to each other. And then if they then die, whatever's left in the pot can be passed on to their children or grandchildren. So it's a very tax efficient family trust. The money also inside the pension is free from inheritance tax. So very, very important, if you can, to certainly try and maximize your pension contributions. So that's a little snapshot of their assets. So what you probably might say is, have they got too many assets? What do they do with it? We talked about they've definitely got an inheritance tax issue. Certainly whilst the money was in the business, that protected the business money, but now the 1.6 million is in the estate, so what do we do with it? And there's lots of things we can do. There's plans to protect it, we can spend it, we can gift it away. So there's lots and lots of options if they want to release the money from their estate, but they have to give up access to it, which lots of people don't actually want to do because they've worked hard for it, they want to keep it, but there's still things they can do. Raj and Simran needed an income, so we had to sit down with them and structure it in the most tax efficient way. And that's where really you need the advice of a financial advisor, because as you'll see in the next slide, we need to find the most appropriate tax vehicles to put this money. We talked about estate planning, wealth preservation, and again, we updated their wills and probably very importantly, took out powers of attorney. So just in case they lose mental capacity, somebody can act on their behalf. So this is what we did with their money. So the ISAs produced £12,000 of income, and all of that is tax-free. The buy-to-let income of £12,000 each is taxable. In this example, I'm just showing you the amount of pension income they decided to draw, which was just under £31,000. That is taxable. And then some of the money that they got from the sale of the business, we could use their capital gains tax allowance as well as their dividend allowance to structure the money into certain investments to make use of those allowances. And then we've also got a bond investment what we can use and draw an income, as you can see, 40,000 each, which is all tax deferred. So in this example, they had £108,000 each, of which only £42,000 was taxable. So extremely tax efficient because we used ISAs, pensions, bonds, investments, and used all their allowances available. So that's the key when we're working with clients who have sold their business and obviously listened to our advice over the years and put the money in the right place. We often see people later on in life who have created lots of wealth but haven't got it structured in the right assets. We often see people with large share portfolios with large capital gains, which means the only way to make it more tax efficient is to pay a large capital gains tax bill. Whereas if they had advice ongoing, then we'd be able to structure that so there'd be a small amount of tax to pay. So with all that money, I then sat down with the Patels and said, okay, what's the plan? And if you remember in the first slide, there was nothing on it. Now we sat down, utilised all that money, and basically we said, okay, we've got until age 75, so 15 years of good retirement where we want to do things. So that included travel, buying a new house, gifting money, weddings, university fees, given to grandchildren, etc., etc. And as you can see, most of that was done in ages 60 to 75. That's the plan. At 80, if they were still alive, we'd plan to have a big holiday there. And possibly at 85, they would look to downsize because they've got quite a large house at the moment. We're still assuming they're going to die at 100 because that's what we have to do. So we have to make sure that they could do all the things they wanted to do, but not run out of money. And that's the key with financial planning, is sitting down with a client, helping them accumulate, but also helping them to decumulate, but not run out of money too soon. So the Patels are extremely happy with all the advice they've received from all of us here. And now it's down to them to enjoy themselves, have a happy retirement, and stick to the plan. We still have annual reviews with them to make sure they're still on track. But it's very much now down to planning what they want to do. Do they want to gift money, and how much do they want to spend? So that's the end of the presentation. Thanks for listening. I'm just going to hand back to Kate because I know we've had some questions come in. So Kate's just going to read out the questions and we'll answer them for you.
Thank you everyone for sending in your questions tonight. We've had quite a few. I'll start with this one. I have in the region of £750,000 cash in my company, and my wife and I have A and B shares. Do these factors affect my claim to ER, and what is the situation generally with entrepreneurs relief?
Okay, well, I think that's a question for me. There's a few things in there, so I'll just try and run through them one by one. Firstly, with the cash, as Tim said, we've talked a bit about cash and how potentially it can, if the cash level is too high, it can disqualify us from getting entrepreneurs relief in the case of a share sale. But it is something we'd need to look at in a case-by-case basis. HMRC will accept a certain amount of excess cash over and above the business's working capital needs, and it really needs to be looked at in relation to the whole deal. So if you would like to give us more details, we would be more than happy to kind of give you a bit more specific advice on that one. The second thing in the question was about A and B shares. And again, there's been some concern about A and B shares, or alphabet shares as they're often known, because of changes in the Entrepreneurs Relief rules that came in from April 2019, which initially said that shareholders needed to be entitled to at least 5% of the profits and net assets of the company, as well as having voting rights. There was a lot of concern at the time this would exclude owners of alphabet shares where dividends had not been issued equally between the shareholders, but HMRC did subsequently explain or clarify that Entrepreneurs Relief would be available as long as with alphabet shareholders, in the event of a disposal, they would be entitled to at least 5% of the proceeds. So it does mean in most cases A and B shares are okay, but you would need to look at the Articles of Association for the company to check the rights of those shares. And again, that's something we can give specific advice on.
Thanks, Atif. Another question we've got here. What are the most common issues that each of you see on sales? Also related to this was, what is a decent lease length to have remaining when selling?
Shall I start off on that one?
Yeah, sure.
So most common issues then, I suppose, from my perspective, around the NHS license and GPHC, so the ownership of the pharmacy license itself. It does get often overlooked after people incorporate, so that does need to be checked. Obviously, if it's caught at a late stage, then it can delay everything, because you've got to go through, you know, if someone is buying the company, the shares in the company, that license has to be in the company before it can be sold. So if it's not caught until late on, you know, obviously that's a process you need to go through before the completion can happen. And the other thing I would say is selection of lawyer actually can greatly affect the speed at which the sale progresses. And we see that quite often where people do appoint a more general lawyer rather than a specialist. You know, as so much information in tonight's presentation, I think it probably goes without saying that there's so many areas of this that are specialists. You know, this is not something that a normal commercial property lawyer can pick up and deal with. So those, from my perspective anyway, are some of the biggest things.
Yeah, sorry, it's Tim at Charles Russell here, and your check's in the post, Scott. Thanks for that one. I think from my side, just coming back to that lease length question, one of the issues that we often see is, you know, whether it's a asset sale or a share sale, you've got to have a marketable lease, because even if you're dealing with an experienced buyer that might be fairly relaxed and take a view about the lease being only maybe 5, 6, 7 years length because it's renewable, if they need funding to support the purchase, the banks will always want to see a minimum of at least 10 years. Some banks say, well, it's the period that's got to be left is whatever the length, the term of the loan is going to be, plus a year or two.
We're seeing quite a few people, their banks are coming back and saying, actually, we want 15 years.
Yeah,
that's becoming more and more frequent.
I think probably because banks tend, and borrowers are tending to take more longer term finance now. So I completely agree with that. So in terms of, you know, what's a safe minimum, I mean, anyone who's got more than 15 years on the lease, I think is in safe territory.
Yeah.
Anyone who's sort of between 10 and 15 is probably okay. Certainly anyone with less than 10, I would be encouraging them to think about trying to get it extended, but that's not a straightforward thing, because landlords aren't obliged to extend your lease, and many don't want to do it until much nearer the time the lease is coming to an end. But it's certainly worth having in radar, so that at least you know to aim off for it. And it may even be, Scott, I don't know, something that one makes a point of drawing to the attention of buyers in part of the marketing phase, simply because you don't want to go through a lengthy marketing exercise.
Yeah,
no, generally, raised at the end of the
generally
process.
we will do that. It will be on the radar. and we normally, if we've got a number of offers on the table, then obviously we can check that in advance with people. I mean, as part of the process that we go through, we make sure we get them effectively to sign off on the lease terms as they make the offer. So if there's any issues there, it should be picked up. Certainly if it's something very low, like 3-4 years remaining, that is that's a big red flag for us, something that we need to check out right at the beginning.
Thank you, Scott and Tim, for that one. This next question, you mentioned supply is expected to fall off. Is it better to wait for this to happen before selling?
Very difficult to say with any certainty, because there are so many factors that are going to come into the valuation. We've got the budget coming up. We don't know what the effects are going to be on the entrepreneurs relief at that budget. That can have a big impact for people. Obviously we are operating in a sector that is controlled by the government, by the NHS, highly regulated, and changes can happen overnight. And we saw that with the cuts just before Christmas, let a land, bang, out of the blue. So it's very difficult to say that. You could hold off. The supply may come down. Actually, I don't think that that is going to push the prices up. I think it's going to add some stability to the market. So, it's a difficult one to answer with any certainty. Things are okay at the moment. There are buyers out there. The prices are pretty good. The ER is still there as we speak tonight. So, it's a reasonable time now.
Okay, thank you, Scott. I think based on time, we'll just do one more. And this one's for you, Paul. Are you expecting any changes to pension regulations in the upcoming budget?
Hopefully not. However, there's always rumours about them removing tax-free cash from pensions, which I don't think will happen. The most likely thing I think we're going to see is tax relief on personal contributions. At the moment, you receive personal tax relief at your highest rate of tax, so 20%, 40% or 45%. So we've got a feeling they may well try and equalise that to make it fairer for all. So maybe 20% for everybody, or maybe a 30% tax relief for all people. They still want people to save into pension, so I don't think they'll tweak it too much. Other than that, I don't think there's going to be anything dramatic, because I don't think they want to rock the boat. There's always changes to pension legislation, and it's quite complex as it is. So hopefully no changes, or if they do, it will just be a slight tweak to the tax relief that you receive.
Okay, so I guess all that remains then is to thank all of the presenters tonight for their time. Thank everyone for listening in. Hope everyone enjoyed it, and good evening to everyone.